Hello, this is Mike Swanson. You're listening to the Inside Wall Street Window podcast. This is where I get a chance to just kind of tell you straight up what I'm doing and what's going on with Wall Street Window. I don't have to worry about how many views this gets or what the YouTube algorithm is going to do in response, because really the only people who listen to this are the people that have been following me for a really long time. What happens is YouTube, people that use YouTube, they like to see the videos that got people in them, or at least graphics, and they just don't click something that's pure audio. So the algorithm kind of hides it, which is okay with me. So here's the thing: in the last segment I did of this, I talked about how I wasn't doing anything in the financial markets. In the past almost 7 days, I've done some buying, and I want to tell you about that. Right before I did that previous podcast, I had actually sold all the stocks that I bought last year. That didn't mean I went 100% into cash. I still had 14% of my money in gold and silver metals ETFs that I had bought a couple years ago and continue to hold as long-term positions. But I had sold some mining stocks that I had purchased 2 years ago and also last fall, among other positions. Now, what I want to tell you is that on Monday, I bought back into mining stocks, and I actually increased the exposure I have in gold and silver. I'm basically now almost 20% invested in my account, all my accounts, in gold and silver metals ETFs. There's different metals ETFs you can buy: SLV, GLD. The ones I have most of my money in, though, are the ones by Sprott, Central Fund of Canada, and the physical gold ETF that they put out. With the mining stocks, I couldn't buy some of them back, such as Newmont, because I sold on the 6th or 7th of February, and I actually had a loss on the Newmont position because I bought it last fall and I didn't want to suffer from a wash sale. So I bought GDX instead of stocks such as Newmont and Barrick and so forth. But it doesn't really matter. I got the big cap mining stock exposure back one way or the other. That said, one of the reasons I initially sold in February remains, and that's my view of the stock market. So I didn't buy REITs back, I didn't buy utility stocks back, and I don't really have plans to do so, even if the utility stocks seem to have firmed up recently. But that's not because I'm bearish on the stock market short term, even though we had a big drop yesterday. It's that two main reasons. The first reason, well, three reasons. The first reason, my view of the market, is that although I don't think we're starting a bear market now, even though we did have a drop yesterday, even though you can point to some signs of extreme speculation in the markets, Bitcoin exhibit number one, the narrowness of the rally, some of the rally leaders of the so-called Magnificent Seven are broken down already. Tesla already broke down weeks ago, but now Apple has broken down. Google's not trading well. It's really Amazon and NVIDIA doing most of the work. Friday, the semiconductor sector as a whole came to life. Every time the market has an up day, as you saw on Friday, people look for signs of the rally broadening out, and then a couple of days later, the stock market gets punched. But the bottom line is what I told you in the last segment holds in my thinking here of guiding my actions, and that is that I think we're in the final inning, the ninth inning of this bull market. When I got bullish on the market in January 2023, I said I think we're in a cyclical bull market. It's probably going to last 2 years, meaning the end of this year or early next year. That's still my view, and I don't want to be in it in the stocks heavily as you are in that ninth inning, because I want to be clear-minded. I want to be objective. I want to have the ability to look at things day to day, and at some point I will think we're headed to a bear market, and I want to be in a position where I may actually bet against the stock market, short the stock market, because I do think we'll just see how things play out. I want to have flexibility, an open mind, and when you have positions, it's human nature that makes it almost impossible. The more heavily you're invested, the harder it is to change your investment views or adapt to changes in the market. So I don't, that's the two big reasons. And the other reason, goes back for the past several, years. As time has gone on, I've made more money, and I've, gotten older, frankly, and I'm not, starting out for trading account with $15,000. So I want to protect the money I have. And part of the reason I buy gold is to do that, to protect the money I have, because I really believe that the next bear market could be associated with a falling dollar, with growing debt problems in the United States. So gold is protection from that happening. I expect gold to go up in the next bear market, and we could see a bear market like we saw in 2022, in which not only stocks but bonds go down too, and gold would be the protection in that case. Gold. So that's why I own gold. It's also why one of the reasons why I increased my gold position starting last Friday when gold rallied $40, and I did it a little bit more earlier this week. Gold looks on the charts better. It looks like it's breaking out. We can say, gold needs the coming interest rate cuts to break out, to resume the falling trend of the dollar. But I think we're heading for some problems with the debt in the next bear market. That could be the so-called reason for it. These are, don't think these are. I don't think that's influencing the action of the stock market now. Bonds aren't falling, but it's it's a story for another day. The story now, and people have been programmed over the past 7-8 years by the way the internet has evolved to think about the short-term cycle, meaning the 24 or 48-hour news cycle. The TV is, of course, driven by that, but the internet is driven by that too, because the content put out by the news media, and not just them, but everyone putting out content, whether it's articles, whether it's tweets, whether it's Instagram, Facebook posts, YouTube videos, all the content is short-term orientated to get the click, because it gets, it's constant content being created and generated. So, the story now isn't the debt problem. The story now that everyone is focused on is Bitcoin, crypto, and so forth. So I wanted to tell you, in this video, some of the changes I made. Bought back into the mining stocks, increased my metals exposure. Still got more money in bonds and CDs than long positions elsewhere, and that's probably going to remain the case. I'm not looking to increase or buy what most people are buying in the markets at all. But I feel obligated to tell you what I'm personally doing. And I'm making changes with the website, or planning to. And that'll be a topic for the next Inside Wall Street Window podcast. As you can probably notice, I'm doing a lot more YouTube content. And that's what I've been focusing on since New Year's, is getting the YouTube channel going. And it's starting to pick up, and that's starting to get successful. But I'm likely to focus on the rest of the month on this. But I'll put out some podcasts like this explaining better where things are going. So all that said, I'll be talking with you later.